Well, we all know already the Bank of Canada has in fact kept rates as they are, but what you don't know is what the data is showing for the next couple of months and how that could impact the rate decisions coming up in the summer and beyond. So in today's video, we're going to talk about not just what happened today, because we all know the Bank of Canada left the overnight rates as is, but what we will talk about and why you're going to want to hang out is where one university professor believes that rates will be going, what the inflation data says, and of course, more specifically, how this could impact the housing market as a whole. So many people are wondering, when is the Bank of Canada going to start cutting interest rates? And the bets are in. After today's announcement with the BOC and their specific tone with Tiff Macklem leaning a little bit more comfortably towards the possibility of rates coming down, there you have it. The probability is in at over 75% likelihood that we will see the first rate cut coming in June of 2024. While this is a little bit later than was originally indicated at the start of the year, it's definitely something that has been trending this way for quite some time. Now, what would be interesting for you is to wonder, why is this happening? And more importantly, are they doing it too late? There's an entire group of people out there who are suggesting that the Bank of Canada has waited way too long to lower interest rates, and this could have a significant impact not only on the housing market, but the economy on the remainder of the year in 2024. This professor specifically states that based on what is going on in the 12-month averages, barring a well above average CPI spike in the next two reports, we could be at 2% or below in the next couple of months alone. This would put the Bank of Canada exactly at the range they want to be, and actually sooner than was actually expected. What this actually means is that it would be putting the Bank of Canada in a position where they would basically have to start lowering interest rates. Now, whether that's once, twice, or three times is subjective to what the market itself will dictate at that time, but there is no doubt they will have to be and will be forced to start lowering rates themselves. So what's happening globally is we're seeing overall across the globe, for the most part, inflation coming down in most major economies, with one exception, and that's the United States. With the US still seeing a very hot market, their interest rates have stayed pretty steady. And if you don't know already, the Bank of Canada likes to not be the first one to lower interest rates. So you best believe that they are watching as far as they can to see when the Fed will actually lower interest rates before they jump in and do so. And what this means for you as a homeowner, obviously, is that if you have that variable rate mortgage, you're probably still paying a significantly higher amount of interest or payment than you want to, which is also impacting the federal governments and all sorts of different budgetary considerations and guidelines and rules that are yet to be announced but likely to be changed. In fact, there are rumors out there right now that they may in fact change the way that amortization schedules work, specifically as it pertains to variable rate mortgage that have fixed payment structures, all because of what's happened in the last couple of years. Now, looking forward, the one thing that we have to watch out for is surprises. Specifically in Canada, oil prices have been up significantly higher than they were expected. In fact, $5 per barrel, more than was expected at this time of year, which will have a negative impact on the overall economy. Other factors to look out for is our overall GDP, which is a little bit surprisingly holding relatively steady, depending on which way that you actually look at the numbers. Now, in many circumstances, there are some economists that do believe that this is primarily because of a high amount of population, and in fact, that is a real consideration. While there are some that are also suggesting that with the fact that the government has changed the rules and now they're reducing the amount of people who are allowed into the country, well, this could actually do a little bit of a reverse effect in regards to the overall GDP growth. Whichever side of the fence that you sit on, there's a lot going on right now, and the question mark is obviously, how does this impact the real estate market as a whole? So here's a few things. I want to provide some anecdotal feedback. We live in the Lower Mainland on the west coast of Canada. However, we do business across the country, including Ontario, BC, and Alberta. And what's been really interesting to note, specifically starting out west in the major cities and working its way out east into smaller towns, is that there have been a significant amount of supply hitting the marketplace and a slowdown in buyer demand. Now, this has not yet resulted in a reduction of house prices, but it has essentially nearly stopped the increase in house prices over the course of the last few weeks. Now, certain markets and certain properties, if priced well, will always be desirable, and we are still seeing multiple offers because while overall there's a limit on the amount of supply of entry-level products in many areas, that being said, it shows that there is some resilience in the price point market and people really have a budget limit. They just can't go any higher. So the question is, when is this all going to come to a head? Will high rates and high monthly payments eventually start to negatively impact people's ability to qualify, therefore pushing prices down? Many suggest no, and what will likely happen is people just won't sell their homes. I think what's likely to happen here is there's a little bit of a lag time because of the emotional impact of people making a decision to buy or not buy real estate based on what the Bank of Canada does or does not do. And so there's very likely a gap right between now and June, if there is a rate cut, where a buyer can still get an incredible amount of value and have more choice in house prices than they've had in the last couple of years. So what you really need to know is that looking forward, at the end of the day, if you're qualifying for a mortgage right now, fixed interest rates are 1.5% lower than your average uninsured variable rate, which means if variable rates come down, you don't actually qualify for more. The relief will be for those people who currently have a variable rate mortgage and those who are betting on variable rates to come down quicker than they have in the past. What I'd like to know from you is, do you believe that this is going to impact rates significantly enough that you'll see them come down 0.75% or 1% before the end of the year? Or do you expect that we're only going to see a 0.25%, 0.5% decrease before the end of 2024? Either way, there will be some form of a decrease, but I'd love to hear your feedback if you want to leave so in the comments below.